Charts, patterns, pricings, they dominate most investing advice. But what if you are missing the bigger picture? While technical analysis watches the market surface, fundamental analysis looks under it, into the business itself. In this video, we'll explore what to look for while reading financial statements, evaluate real company value, and make investment decisions based on substance, not just signals. My name is Ivan, and welcome to MagnaTrade. Let's hop into the video. But at first, let's begin with key fundamentals that influence all markets. Interest rates are set primarily by central banks, for example, the Federal Reserve or the European Central Bank. Affect borrowing costs, investment decisions, and asset valuations. Higher interest rates, lower asset prices. Lower interest rates, higher liquidity, boosting markets. Inflation measures the rate at which prices are rising. High inflation erodes purchasing power and can lead to rate hikes. Low, stable inflation, favorable for long-term investing. Economic growth, gross domestic product, GDP. It reflects the health and size of the economy. Rising GDP, higher corporate earnings, increased demand for commodities, stronger currencies. Falling GDP, recession risk, market slowdowns. Employment and wage growth influences consumer spending, which drives much of economic activity. High employment, strong demand, rising corporate revenues. Rapid wage growth can lead to inflation concerns. Monetary policy. Central bank actions, such as interest rate changes, quantitative easing or tightening, determines market liquidity and confidence. Monetary easing, more liquidity, and bullish markets. Tightening, reduce liquidity and bearish pressures. Fiscal policy, government decisions on spending and taxation. Stimulus spending boosts economic activity. Austerity or high taxes reduces disposable income and demand. Global trade and capital flows. Trade balances, import-export activity. Geopolitical stability. Conflicts, sanctions, or political uncertainty can disrupt supply chains, increase risk aversion, boost safe haven assets. Market liquidity and sentiment. Liquidity, ease of buying or selling assets without affecting price. Investor sentiment, optimism versus fear drives short-term movements across markets. Now, as you understand what factors influence all markets, let's discuss every market separately, beginning with currencies. Trade balance. A positive trade balance, surplus, means more exports than imports, increasing demand for the domestic currency, since foreign buyers must convert their currency to pay. A deficit puts downward pressure on the currency, as more local currency is exchanged for foreign currency to pay for imports. Current account balance includes the trade balance plus net income from abroad, interest, dividends, and transfers, for example, foreign aid. A surplus typically strengthens a currency, while a deficit weakens it over time due to sustained net outflows. Capital flows refers to foreign investment in domestic assets, stocks, bonds, real estate, etc. High inflows, portfolio or direct investment, strengthens the currency due to increased demand. Outflows weaken it, especially in developing or politically unstable countries. Foreign exchange reserves and central bank intervention. Central banks may buy or sell their currency to stabilize or influence its value. A country with large forex reserves, for example China, can defend its currency during volatility. Regular intervention can also signal policy direction and influence trader behavior. Sovereign credit ratings, provided by agencies like S&P, Moody's, Fitch. A downgrade in credit rating signals higher default risk, weakens the currency. Upgrade boosts investor confidence, strengthens the currency. Political and regulatory environment. Stability attracts foreign investment, strengthens currency. Political uncertainty, weak institutions, corruption, or sudden regulatory changes may trigger capital flight, weakening the currency. Market sentiment and risk appetite. In times of global risk aversion, investors often move into safe haven currencies like the US dollar, Swiss franc, or Japanese yen. In contrast, during risk-on periods, investors may seek high-yielding risk currencies, like Australian dollar, New Zealand dollar, or emerging market currencies. Some currencies are directly linked to the commodities market. For example, Canadian dollar. Since Canada is one of the biggest producers of crude oil and natural gas, rising oil strengthens the Canadian dollar. Let's proceed to stocks. Corporate earnings, EPS, earnings per share, core driver of stock prices, measures the net profit attributable to each share. Consistent or growing EPS typically leads to higher valuations, while declining EPS can lead to stock price drops. Revenue growth indicates whether a company is expanding its sales base. Strong revenue growth suggests demand, market expansion, or successful product strategies. Watch for top line revenue growth even if profits are flat, especially in early stage companies. Profit margins. As is operational efficiency, gross margin equals revenue minus cost of goods sold divided by revenue. Operating margin equals operating income divided by revenue. Net margin equals net income divided by revenue. Declining margins may suggest rising costs or pricing pressures. Return on equity, ROE, measures how effectively a company uses shareholder capital. High ROI generally indicates better management and profitability. Price ratios. These valuation metrics help compare stock prices to financial performance. High P/E equals gross expectation or overvalued. Low P/B, potentially undervalued assets. If PEG is lower than 1, it equals undervalued growth. PS, useful for unprofitable or early stage firms. Dividend yield and payout ratio. Dividend yield equals dividend divided by share price, indicates income return on investment. Payout ratio equals dividend divided by net income, assesses sustainability of dividends. A very high ratio may signal risk, company guidance, and earnings surprises. Management often issues forward-looking guidance on earnings, revenue, and operations. Stocks may react more to guidance surprises, positive or negative, than to the actual reported figures. Earnings beats often trigger price rallies. Competitive position and market share. Companies with strong competitive advantages, for example, brand, patents, network effects, tend to perform better. For example, Coca-Cola or Apple are likely to perform well in the long run. Market share equals total industry sales divided by company's sales multiplied by 100%. Losing market share may signal trouble even if revenue remains stable. Sector and industry trends. Stocks often move in tandem with their sector. For example, tech, energy, healthcare, etc. Trends like digital transformation, energy transition, or demographic shifts can create long-term winners. Management quality and corporate governance. Competent, transparent, and shareholder-friendly management adds value. Frequent scandals, insider trading, or poor communication may deter investors. Mergers, acquisitions, and restructuring. M&A activity often leads to stock price spikes for the target or dips for the acquirer. Restructuring, spin-offs, and buybacks can alter the company's value proposition. Insider activity and institutional ownership. Insider buying can signal confidence from executives. Institutional ownership, mutual funds, pensions, hedge funds, often provides support and liquidity. Main factor in the moves of commodities is supply and demand levels. Commodity prices are highly sensitive to supply fluctuations. For example, lower quotas from OPEC reduce supply, prices rise. Droughts, hurricanes, floods disrupt agricultural and energy commodities, making them rise in value. Industrial and consumer demand, the real economy's demand for raw materials, significantly impacts prices. For example, construction and infrastructure need a lot of steel and copper. Higher demand equals higher prices. Geopolitical events and conflict. Geopolitical tensions often affect energy, metals, and agricultural commodities. For example, Middle East conflict will affect oil and natural gas. Prices would rise due to supply disruption. Seasonality. Commodities are strongly seasonal in both production and consumption. For example, natural gas rises in winter due to heating demand. Inventory levels and storage data, measured in weekly and monthly reports. Inventories show how tight or loose current supply is. Low inventories signal scarcity, higher prices. High inventories indicate oversupply, lower prices. Futures market and speculation. Commodities are traded via futures contracts, which reflect the expectation of future price movements. Large speculative positions by hedge funds or traders can create volatility. A contango or backwardation structure in futures markets affect trading strategy. Contango is when future price is higher than spot, it signals oversupply. Backwardation is when spot market is higher than the futures price, signals tight supply. Substitution and technological change. Some commodities are interchangeable, or new technologies may reduce demand for one in favor of another. If natural gas becomes cheaper than coal, industries shift usage. Now, let's discuss crypto fundamentals. Network activity and usage. The value of a cryptocurrency often depends on how much it's used and how active its network is. You can check it by transaction volume, number of active addresses, and fees generated. High levels in them provide a bullish sign. Tokenomics, supply dynamics. Crypto assets often have fixed or algorithmic supply rules, and price is very sensitive to those mechanics. Maximum supply cap, scarcity creates long-term bullish case. Emission rate and inflation, low issuance equals deflationary pressure. Halvings, historically followed by bull markets. Burn mechanisms, reduces total supply, equals price support. Ecosystem growth and adoption. Crypto networks like Ethereum or Solana support dApps, DeFi, NFTs, and stablecoins, all of which create demand for the base token. High demand of ecosystems may reinforce the coin. Exchange and liquidity factors. Listing on major exchanges, liquidity depths, stablecoin inflows, all signal bullish signs. Regulatory news and legal environment. While macro in scope, crypto is especially sensitive to jurisdiction-specific regulations, on-chain metrics, and whale behavior. Advanced crypto analysis includes tracking blockchain data, on-chain analysis. Whale accumulation, meaning large wallets accumulating, equals bullish. Dormant coins moving, meaning sudden activity from long dormant wallets, equals bearish. And VRV ratio, market cap versus realized value, used to assess over or undervaluation. Developer activity and protocol upgrades. Cryptocurrencies are open source software projects. Their evolution depends on developer effort and technological upgrades. Therefore, the more active the developer is, the more likely coin will rally. Sentiment and community dynamics. Crypto prices are strongly influenced by social media, narratives, and hype cycles. Let's summarize. Markets are shaped by interest rates, inflation, GDP growth, and employment, which influence asset prices and investor decisions. Monetary and fiscal policies affect liquidity and confidence through rate changes and government spending. Currency values depend on trade and capital flows, political stability, and ties to commodities. Stock prices reflect earnings, valuations, dividends, and sentiment, with added impact from sector trends, inside activity, and management. Commodity prices are driven by supply levels, global demand, geopolitical events, and speculation. Cryptocurrencies respond to network activity, tokenomics, ecosystems growth, and regulatory developments. Now let's quickly find out where to look for this data. To show you where to check for every piece of data, we'll take another video, which I will do at some point. But now let's review only the main websites that I use, investing.com and Reuters. First, I want to emphasize that there is a lot of useful information on all of the sources, and you can find news affecting markets in every of the featured sections. Investing.com. Just from the way it sounds, you can guess that every article here contains information that affects markets. Among the features I like are sections of news for every type of market you want to trade. Stock markets, cryptocurrency, commodities, and forex. Also, a very useful feature is breaking news. Also, there is a very detailed analysis of every asset if you type its ticker into search. For example, let's look at Apple. I typed AAPL, and there are quite a lot of things you can look for here. For example, you can see previous close, open EPS, net income, revenue, etc. There are quite a lot of metrics here, as you can see. Also, you can look for specific news regarding your asset, either in the bottom of the page or in the top in this section. Also, the feature I like is sentiment. You can mark your sentiment, for example, mine is bullish, because 200 level is quite strong in Apple. Also, you can look for detailed information about sentiment here. In the recent sentiment section, you can look for more detailed data, when and who placed their sentiment. And also you can see a summary of sentiments here for the all sentiment, for the last weekend, for the last 3 days. Also you can see our sentiment here. Reuters. Reuters reporting is valued for its objectivity and speed, often serving as a first source for breaking market relevant stories. There is one distinctive advantage. Reuters provides a morning news digest, which you can find by typing morning bid in the search. Additionally, there are two of them during the day, one for the European market and time zone and the other for the US. Also, I want to briefly mention Finviz for its latest news feature and the insider section, which shows when influential people or companies' leaders open big positions. However, guys, a quick note here. These are the sources I use, and I don't recommend using only them and nothing else. You can prefer Bloomberg's, The Economist, CNBC, or something else, for they all have unique advantages. Now let's look at the example from the real world when fundamentals proved to be correct. Euro rally in 2017. Even though the 2010s were generally good for the Eurozone, 2017 was distinctive. Let's review the reasons why it was so. Robust GDP growth. The euro area experienced strong economic performance, with real GDP increasing by 0.7% quarter on quarter in both the second and the third quarters of 2017. Improved labor market. Rising employment levels supported private consumption, contributing to the overall economic expansion. European Central Bank's accommodative stance. The European Central Bank, ECB, maintained its asset purchase program and kept interest rates at record lows to support inflation and economic growth. Market expectations. Despite the ECB's dovish stance, market participants anticipated a gradual tightening of monetary policy due to the improving economic outlook, leading to increased demand for the euro. Attraction of capital, the positive economic indicators, and expectations of policy normalization attracted capital inflows into euro-denominated assets, strengthening the currency. Strong current account surplus. The euro area maintained a substantial current account surplus, around 3% of GDP in 2017, indicating strong export performance and contributing to currency appreciation. Outcome: euro appreciation. The convergence of these factors has led to the strengthening of the euro. This example illustrates how multiple fundamental factors can interact to influence currency movements. Stocks. Post-COVID US tech rally 2020 to 2021. Key factors at play. Monetary and fiscal stimulus. Near zero interest rates and massive stimulus checks fueled consumer demand and market liquidity, corporate earnings, and growth. Tech firms like Amazon, Apple, and Zoom saw explosive revenue and EPS growth due to digital demand, investor sentiment, and sector trends. High optimism toward tech and digital transformation created speculative momentum. Outcome: the Nasdaq and major tech stocks hit all-time highs. Valuations soared, supported by growth fundamentals and record low interest rates. Commodities 2000s commodities supercycle driven by China. Key factors at play: economic growth. China's industrial boom led to massive demand for oil, copper, steel, and agricultural products. Supply constraints. Years of underinvestment in mining and energy limited the supply response. Geopolitical stability. Relative global stability supported uninterrupted trade and infrastructure expansion. In addition, surge in exports from resource-rich countries led to commodity-linked currency strengths. For example, Australian dollar and Canadian dollar. Outcome: prices of oil, copper, coal, and agricultural commodities surged, benefiting producers and creating one of the longest commodity bull markets in history. And a quick bonus in the end. Currently, it's 9th of June 2025, and one of the main indicators for last half of the year are Trump's tweets. As an example, we can look at the recent argument between Elon Musk and Trump. This is how it started with a tweet from Elon Musk. Then Trump continued it answering a question on the press conference, and you can see his answer on the screen. In the end, they had been exchanging offensive tweets for a day. Outcome: almost all assets steeply fell, especially cryptocurrencies, 4% for Bitcoin and almost 8 for Ethereum. That's it, guys. I hope you found something useful in this video. Comment, like, and subscribe. Thanks for your attention. See you in the next one. Goodbye.